Hey, if you subscribe, like, and drop a comment, like the first person will pick a random and you get a free whatever program they have, for free. So I want to do the same thing. Like, hey, we need to get to 1,000. We got 98. We're 12 away from 1,000. So if you subscribe or like and comment, then I'm just going to send them the next 12. I'm going to send them an autographed copy of my book, and then anybody above that will just raffle a 13th.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, and welcome to episode 41 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and guys, I made it. I appreciate you waiting for me. I had a little bit of a flight delay, driving home in my Jeep in the rain, just flying down the highway, but I made it. So that's all that counts, right? And you guys did a little prank on me, said make sure to wear white. And they all showed up in black. So I guess I deserve that. It was probably orchestrated by you, right, Jay?
Actually, it was not. I can't take credit for this one. You get two more guesses.
Mauricio.
There you go.
The little trickster. How's it going, Mauricio?
Doing good, man. I'm switching it up today. Are you gonna ask me what I'm drinking, or are we gonna ask Jay first, as always?
Well, I usually ask, how's it going? And then, if you have something funny going on, you talk about it. And then I ask you how, what you're drinking. But what are you drinking?
We're episode 41. We're going to figure this out eventually.
Yeah, how does this work? So can you work through the format again? I'm not following the format.
Mauricio gets mad when he doesn't go first, but when I go at him first, he doesn't know what to do. He's like, "Oh, you could ask me what I drink? Oh, I don't know what to do. What to do with my hands? I don't know."
Here's what I'm doing today. I'm mixing it up. As you guys know, I'm a wine drinker. I don't usually drink any hard alcohol, except for a little pisco action. And I know one of our listeners is listening from Chile, and he's been pushing me to drink a little pisco. And so I went to the store. I was actually looking for a friend of mine has a great pisco called Catan, but it wasn't there. So I got my traditional pisco, Chilean pisco Alto de Carmen with a little ginger ale. So it's been delish. But check this out. I'm going to do a comparison. I busted out this bottle. I thought this bottle looked like $1 million. So this is a Peruvian pisco. So I don't know how good it is, but
what is pisco? I don't even know what pisco is.
Pisco is like, it's like a hard alcohol. It's like, it's like tequila or gin. It's like the Chilean tequila. Let's put it that way. Think of tequila in Mexico. When you think of Chile, you think of Peru, you're going to think of pisco sour. Pisco is a hard alcohol that you mix with Coca-Cola, a little pisco sour. I like it with ginger ale and a squirt of lime, which is right here. Just a little squirt on it, and it's delish.
Well, anything's delish when you put lime and ginger ale, but that's...
Kyle, but before you get off of me, though, Kyle, I got one more thing to say. I just looked on YouTube before we came on, and we're at 988 subscribers. 900. That means we're 12 short of 1,000. So I have decided, with the approval of everyone except for you, because you showed up late, that for those of you who actually subscribe on this episode, actually, if you've already subscribed, that's fine too, but subscribe. If you like this episode and then drop a comment, I'm going to send the next 12 people an autographed copy of Legal Strategies for Everyone.
Are we supposed to tell them to tag someone too or something? Isn't that the way you...
No, this is easy. It's going to be subscribe, like, comment. The first 12 get the book. Just get me your email, your address. I'll sign it. I'll send it over. And then if more people want to do it, then we'll just do a raffle for number 13. But I'm giving away 13 Legal Strategies for Everyone's books, autographed.
Wow. I knew it was a special episode when I saw the chest, and you must have freshly waxed for us. So it's anyone who's watching on YouTube, you should go check it out.
Yeah. It's funny. Before you got here, AJ and I were comparing chest hair, and one of us won, and it was not me.
We had to stop. Jay was getting a little too hot and bothered, so
I must admit that the red chest hair on AJ was quite distracting.
Every time, gets them every time.
Wait! I saw Ernie move back there when he was showing his chest hair. Ernie started moving back there.
Prehistoric. That's how it is.
Prehistoric chest hair. How's it going, buddy?
Going good. Got my red cup here full of my classic Diet Coke, the good stuff, ice, the good ice, as we've already discussed. That really makes it.
Well, we'll preface this episode. AJ might deke off at the end. Sometimes he doesn't tell us that he has to leave. Just all of a sudden he's just gone. But luckily he told us this time. So we will be looking out for that.
Keep you guys on your toes.
Jay, how's it going, buddy?
Going well. Yeah, I'm tired, but I'm good. And normally I'd be drinking coffee right now. The last couple of weeks, I brought the coffee in with the Baileys or the Costco, whatever that was last week. And I wanted to do it again this week, but I've got a flight in about 10 hours that I need to jump on. So if I did the coffee right now, I don't think I'd go to sleep tonight. So I'm going back to the Knob Creek smoked maple bourbon.
Ah, nice. Looks like you're making your way through that. That's good.
Look at that. I'm halfway through the bottle.
Yeah, nice. Well, Jay, we appreciate you because my wife Ashley and I were on vacation for a few days for our kids' spring break. So Jay had to pick up the slack on the company and take care of stuff. And we were out on a boat with very little cell service, and it doesn't seem like anything blew up. So you must have done a good job.
When you say boat, you mean cruise ship?
Yes, cruise ship. Yeah. I was with part of the wolf pack. I've decided that not to call them the dog pack anymore. Apparently there's a bad connotation, but if I say wolf pack, then that sounds a little bit better. So I was with the two Ashleys on the boat, and yeah, a lot of drinking and a lot of shenanigans. So I'm actually hair of the dog here.
Who was watching your kids?
No, they came with us.
I know, but who was watching them while you guys were getting shenaniganed? Who was watching your kids?
Well, sometimes it was us, and sometimes these cruises, I didn't know, because this was our first cruise, I was saying last time. Like, they have these kids clubs that are like free. So like, if you just want to break from your kids for an hour, you just go and stick them in the kids club, and they just show up, they take them, and you're like, go to dinner, and then you come back and get them whenever you want, like up until 1 a.m. It was crazy.
1 hour, 5 hours, the whole trip, whatever.
Yeah, no, it was great. A couple stops, and it was everything went smoothest, other than the fact that you guys ever worn those seasickness patches?
Yeah.
They go behind your ear, and they have a little disclaimer on them, a little foreshadowing here, a little disclaimer that says, after you put your patch on, immediately wash your hands thoroughly. And, it's just like any other disclaimer. You're like, okay, whatever. Well, apparently we should adhere to the disclaimer, because my wife woke up the next morning and started freaking out that she can't see anything. And she can't see her phone, but she holds her phone farther away, and she could see it farther away. She's like, I'm going blind. And so we start frantically looking things up. And apparently these patches, if you touch them and then touch your eyes, it can dilate your pupils, and you get nearsighted or farsighted, or I can never keep them straight. And so we turned the lights on. I looked at her pupils, and they were like saucers. They were just massive. So anyway, she spent half the trip with not being able to read her phone or anything. So it's another reason Jay was a rock star, taking care of our business. But anyway, let's get this show on the road, because so AJ can stick around for as long as possible. We have talked in length about how high interest rates in the past affected real estate and businesses, but we really haven't touched on how they're affecting the government. Well, as the government has been replacing old low rate in treasuries with new higher rate treasuries, the debt service that they have to pay on those treasuries has climbed from 1.1 trillion towards 1.6 trillion. So any normal business that sees a 45% increase in their debt payments would probably spell disaster for them, but hasn't really been talked about much in the media. So Mauricio, is this something that we should be discussing more?
Wait, I'm going first?
So funny.
I get to do a little economics. How did Jay give up his economic stranglehold on this one? I'm not quite sure what's going on, but yeah, look, I'm going to share a quick screen. I know, look, if you guys aren't watching on YouTube, listening on podcasts, we all appreciate you. I would maybe suggest going over to YouTube real quick, but I'm going to show a graph, which is what caught our attention last week, and it's a graph that shows the U.S. interest, not the debt, not the deficit, but the actual interest payments on the U.S. Government debt. And this little graph shows that as of February of this year, so about 2 months ago, or a month and a half ago, we were already crossing the $1 trillion mark in terms of how much we're spending annualized every year, obviously annualized every year, on the interest on the debt. And what this graph showed was that if this continues and interest rates, for example, did not go down and they just kind of stabilize, if the Fed didn't cut this year, just continue, that number based on the higher interest rates would actually get to about 1.6 trillion at the end of the year. And if they did cut, 150 basis points over the next, few months, then that would still be going up to 1.2 trillion. And that's really what caught our attention. And I've been paying attention to it over the years, but honestly, I just haven't been paying attention lately because this is something I've, probably, I remember 6 or 7 years ago, just thinking through when interest rates were at zero, the Fed's interest rates were at zero. I knew that the government was paying an average about 2.25%, 2.5% interest on the debt. And back then the debt was, somewhere in their 20s. And so you just start doing a little bit of math and say, hey, look, if interest rates start going up at some point in the future and got back to the historical average, which is, usually around 5%, you're looking at a huge interest payment, which at the time was like $1 trillion or $1.5 trillion, which is just a massive number because when you think about it, the government's revenues, that means all the money it collects last year was $4.6 billion. So the amount of money the U.S. brings in, of course, it doesn't make any money, it just collects taxes. But of the 4.6 billion, 1 trillion right now, potentially 1.5 trillion is going to be just on interest payments alone. Now, I was a little suspect because the source of this one was, was Zero Hedge, which I like. I enjoy Zero Hedge, but I understand it's got a little bit of a bias. So I said, hey, let me confirm this. And sure enough, I found a little bit more mainstream confirmation of what this number looks like, and that was Bloomberg. So Bloomberg had come out with an article showing that as of October of last year, our interest on the debt had just passed the $1 trillion mark. So that's kind of where we are now based on current interest rates. And of course, as interest rates, even if they don't, obviously they're not going to continue to rise, but as interest rates continue to rise, if interest rates don't come down and sustain the same, then the average interest that you're paying on the debt keeps going up because we used to be at 2.25, 2.5. Now the current interest rate that we have to pay is, whatever, 5.25, which means as you start turning over this interest and getting new loans, the interest rates are going to be at 5.25. So the blended rate of the entire $33 trillion in debt turns out to be now 3.2, 3.3. And if the numbers don't come down, if the Fed, maintains interest rates at that level, then you're going to just keep creeping up and interest rates will get to 3, 3.5, 4, 4.5. And the debt obviously continues to explode. Our budget deficit is 1.7 trillion, which means every year we add $1.7 trillion to our debt. Now, AJ's got an interesting stat that I don't want to blow his excitement about that. Now, look, the official government, the Congressional Budget Office, does disagree a little bit. They came out with numbers saying our deficit was actually 870 billion, at least for last year, which is still a big number, right? But these are now the 2024 fiscal year, which started in October. The debt is the interest payment on the debt is just going berserk, and our debt's doubled in the last 10 years. If you go back to 2014, our debt was 17 trillion. Now it's 33 trillion. It's going to get to 35. It's going to get to 40. So not only do you have interest rates to deal with, but you have obviously the ongoing debt that continues to increase. And I don't think anybody on this panel or anybody hopefully listening thinks that anytime soon the debt's going to start going down. Right. If anything, the rate of increase might go down. Maybe we don't get to 35 and 40 right away because somehow the politicians get around to not spending as much more money than they have. But, our revenues are 4.6 billion. Our expenditures are 6.2 billion, which means that's where the $1.7 trillion deficit. And the problem I think we have, and I'll let you guys speak here in a second, but the problem is that at some point in the system, when you have to start borrowing money to pay interest on something, that is just the beginning of the end.
Paying off your credit cards with your credit cards.
Yeah, it's like, hey, your minimum payment on your credit card. I don't care if you have that's a great thing. Let's just talk about your personal stuff. Like, let's just say you have a personal credit cards and you have $1 billion in debt. Like, it doesn't matter. Like, what's your minimum payment? What is your debt load that you have to sustain month after month after month? And if you're making, $60,000 a year, $5,000 a month, and your monthly payment is $1,000, hey, that's manageable. But if your payment goes to $2,000, $3,000, $4,000, at some point you just can't continue to service that debt, and you have to start borrowing more money in order to pay the debt. And so it just escalates. It really becomes kind of an exponential problem. And I think the main problems, and then I'll turn it over to you guys, but I think the main problem is really, I think, threefold, right? Number one, I think the first thing you got to admit that this is what's going on now when, things are supposedly pretty good. It's not the end of the world. Inflation supposedly is under control. Interest rates are about to start going down. I'm like, what happens when you have that emergency situation that happens every so often, and now you're going to have to borrow money? Because that's really what, when people start borrowing money, theoretically, is when you have a recession and you're in hard times. We're in the good times. And if we're doing $1 trillion deficits, $1.7 trillion in deficits and $1 trillion in interest payments in the good times, what's going to happen when there's not so good times. And then, of course, the big thing also is just that you're starting to spend more money on interest on the debt than you are on other more important, theoretically anyway, more important things like, the other mandatory spendings that we have, Social Security, Medicaid, defense spending, all of that stuff. The more money we spend on interest is less money that we have to spend on other things that I think we all agree are, if we're going to spend money to begin with, we probably want to spend money on other stuff other than interest on the debt. And finally, it's just not sustainable. I mean, this is the beginning of the end when you start borrowing money to pay money. So it's a big problem. And I wonder, and maybe this is going a little bit on the extreme, but I wonder if, this is one of those things where it's not really an issue until suddenly it becomes an issue, right? And that literally can become from one day to the next where some big news thing happens, but
it is sustainable until it isn't. It's one of those things where, like, how many times have we said, oh, our debt to GDP, once it hits 100%, we're in trouble. Once it hits 125%, we're in trouble. Like, we keep just making up these kind of like ceilings that if once we pass that, we're going to be in trouble. But like, that's not going to happen. The thing is that like treasury bills are always going to be in demand in our current economic situation globally, because that's basically banks need collateral, and banks, like, it's the way things are traded between countries and people need them more or less. And so they're always going to be in demand. The problem is that something is going to happen at some point. It's trading between banks, whether we get like a, the CBCD coin or whatever, like where they have some system where it's easier for people to trade amongst currencies, amongst banks and stuff like that. When something like that happens, that could be the catalyst that all of a sudden, oh crap, people don't need treasuries as much, people don't need dollars as much, and that could be in trouble. But like, I don't want to wait that long until something like that happens.
Well, the problem is it's a self-fulfilling cycle. So the problem is here, though, we won't know when it's too much until way later. So theoretically, we could have already passed too much. We may have been already gone past that point, and we won't know it yet. So right now we have debt that is rising at $1 trillion+ every 100 days. Our debt is rising at $1 trillion every 100 days. Until the last 5-6 years, we'd never even had a year, even in the financial crisis, where our debt went up $1 trillion. So at some point, what happens is, combined with interest rates, lower abilities to pay, the debt is a self-fulfilling cycle. So you get more debt, you can't borrow as much. You can't borrow as much because you're not as debt worthy. That means your interest payments start to rise because your credit rating drops and you have less people. As that debt turns over, it doesn't turn over at lower rates, it turns over at higher rates. Now, all of a sudden, you get into a cycle that is a downward cycle that you literally can't get out of. And this is what happens to countries. They think they're fine. But then all of a sudden, when they're not, they didn't realize they were not a long time ago. It had already started. And then 5 years later, they're figuring out, oh, that's when the problem started. It was back then, right? But you don't realize it until you're already in the death cycle.
And here's the thing, and I think I want to dumb this down a little bit, because I think there are things that we take for granted that we understand, that the average person, maybe even the average person listening to this, doesn't understand. It's not a bad thing. I think it's not obvious stuff. It's stuff,
or even the average senator or congressperson.
Yeah. So when we talk about the debt, what we're talking about is the issuance of treasury bonds. So when you're hearing things like treasury yields right now are at 4% or 5% or 6% or whatever that is, it sounds great if you're buying bonds. And you think about, okay, well, 4% treasuries is bad because treasuries correlate to mortgage rates. And when treasuries go up, mortgage rates go up. And people understand that. But what I think some people miss is that treasuries are literally the instrument of debt for the US. So when you hear that treasury yields are 4%, what that means is every time that the government needs more debt, they need to start paying 4% to issue more treasury bonds. And so these days, with treasuries at 4% or 4.5% or 5% in some cases, every time we issue new debt, it's going to be at 4.5%, or 5%. But it's actually worse than that, because remember, these treasury bonds have some expiration period. So we have 30-day treasury bonds and 1-year treasury bonds and 2-year and 5-year, 10-year, 20-year, 30-year. And so even if the government today said, we're going to stop deficit spending, we're no longer going to issue any debt. Like next year, we're going to make sure we balance the budget. Even if they did that, unfortunately, the bonds that they issued 5 years ago, the 5-year bonds they issued 5 years ago, and the 10-year bonds they issued 10 years ago, and the 2-year bonds they issued 2 years ago, they're expiring. So the government has to issue more debt to replace the debt that's expiring, even if we're not making more debt, even if we're not deficit spending. And the reality is interest rates now are higher than they've been for the last 15 years.
And higher than our GDP. So they're higher than we actually grow. We're in a negative spread.
Right. And so every single time any bond that's been created in the last 15 years expires, we're now replacing it with a bond that's more expensive, with debt that's more expensive.
By like 3-4 times.
Exactly. And so even if we stop deficit spending today, even if we balance the US budget today, our debt is going to go up for as long as interest rates stay high. And so I think that's something that people need to recognize, that this problem doesn't even go away when we balance the budget and start doing things in a way that's fiscally responsible. We still have this problem. We actually have to take other measures potentially to fix this problem.
It'd be a good start, though.
And two, it's not something we can pay off, by the way. A lot of people are like, well, why don't we pay down the debt? We don't have the ability to.
Yeah, but nobody wants austerity, right? Nobody wants cuts. I mean, there's already mandatory things that nobody wants. Can't touch Social Security, can't touch this, you can't touch that. So, I mean, we're already kind of in a precarious situation. But I think where I'm concerned about is that at some point, I don't know, again, this is to the point where it's already happening. So it's just a question of, it's all about perception, right? So it's like at some point, people are going to wake up and they're going to realize, wait a minute, when I pay my taxes, when I send a check to the government, right now, 25 cents of every dollar, 25%, if we're taking this, 1.1 trillion over 4.6 billion of revenue, a quarter of my money is going to pay interest on the debt. And as that number gets higher, it's going to get to the point where like half of the money, like if I write a check for $20,000, I'm making 60 grand a year, I'm paying 10, 20, $30,000 in taxes. Half of that is going towards paying interest on the debt. And there's no more money to go buy whatever else I think the government needs to be paying for, whether it's healthcare, whether it's education, whether it's, Social Security, whatever it is. I think at some point people are going to be like, wait a minute, you can't just keep raising my taxes. My taxes are just going to pay this debt. And they're going to realize that all this debt does affect them personally, because the only way we're paying this is either a combination of tax receipts, which comes from us, or just borrow more money, which means we got to pay that money future. And at some point it's going to hit people's pocket, or realize that it's hitting their pockets.
Well, it has to be declared a crisis, right? Like as a country, we don't act until something becomes a crisis. And I think it was Mauricio or Jay that just said it, where like, it's basically like political suicide to say, hey, we're going to touch Social Security or touch, one of these other things that the government needs to pay out. So the point is that no one's going to touch it unless they have to, until it becomes a crisis. And, let's just look at the US government as a business. So if they're, a business takes on debt, they have money that comes in, and right now they're just taking more and more debt and they're paying more and more for it. It's just this business somehow is able to create more money to pay off their own debt. But at some point, they're going to have to either A, make more money. So that is raising taxes or inflation, which is basically a secret tax, or they're going to have to pay less expenses. Or the third result is default, which, at the end of the day, it'll never happen. We're never going to default, but that might be the best solution to this situation, because as Mauricio pointed out before, we're snowballing right now. We're issuing more debt to pay our current debt.
They'll default on their citizens first.
Just to put this in more fine point terms that I think should be terrifying to everybody out there. This is 22. For those that are watching, what we're looking at is a graph of 2023 government revenue, basically how much tax dollars the government collected, and their total outlays, how much they needed to spend. And for those listening, basically what this shows is that in 2023, the government collected $4.4 trillion of tax revenue. They spent $6.1 trillion in expenditures in 2023. Now, if you look at how this is broken down, and again, I'll say it for those who are just listening, basically $3.8 trillion is mandatory spending. So this is the ACA, this is Medicare, this is Medicaid, this is Social Security. Basically, the things the government is legally mandated to spend money on unless the laws change. 3.8 trillion. Of the 4.4 trillion that they collected last year, 3.8 goes to mandatory expenditures. 700 billion goes to, well, in 2023, if you believe the government's numbers, 700 billion went to interest payments. So right there between the mandatory spending and the interest payments, which if I think we can all agree, interest is just as mandatory as anything else, if not more, $4.5 trillion in mandatory spending plus interest payments, and we only made 4.4 trillion. So even if we didn't spend another dollar on discretionary spending, and discretionary spending is all the other things that the government spends money on that helps the people and helps the country and helps businesses, even if we didn't spend a dollar more than we absolutely legally had to spend, we're still deficit spending. We're still spending more money than the government brought in 2023. That is terrifying.
We're at almost 40% of GDP. So our government size has doubled in the last 50, 60 years. So prior to the world wars, we were under like 15%, right? So our government is now at almost 40% of our GDP is the government. So there's a correlation to the government's size, right? Obviously, it's spending, and also a slowing economy. This is why this becomes a death knell. As we accumulate more debt, that's not just a government problem. That trickles down into the economy. Why? Because accumulating debt and the pressure of it and the lack to pay it actually rises the debt for the economy. So you can actually get to a point where the government, not actually, you will get into a point where government debt drives interest rates for everybody else. And because their debt's overload, interest rates rises. Now the economy can't grow because it no longer has the capital and resources to do it. The United States economy has been slowing down for the last, 40 years, and its debt has been increasing to basically offset it. So as the economy slowed down, the U.S. government has grown, the government itself, its spending has grown, and it's basically taken the GDP portion that has not been growth anymore. So the government has been interjecting and becoming the growth of our country. Yeah, that is vastly not only unsustainable, but it starts to actually have an inverse correlation. Instead of growing the economy, which is really good when they first start. So when the government starts spending more, printing money and growing and hiring people, everything else, that's like a shock to the economy. It's steroids, right? Because the economy was never operating under that premise. Now you're injecting billions and billions of dollars. The government's doing infrastructure, it's hiring people, and everybody's like, this is amazing. Our economy's growing so much. We should, these politicians spending this money, growing our government stuff, this is incredible. But then at some point, the inverse happens, where all of a sudden all of that does the opposite. It actually starts to crush the economy. And we're at that point at almost 40% government, where we are now getting the negative effects, where we went for 25, 30 years, starting in the early 90s, right? Late 80s, where we were really getting the benefit as our country injected capital and grew, and fiat currency really took hold, and the government learned all these cool things that they could do. We really benefited from that. And now that benefit's over.
Yeah, and it took me a while to figure this out, but to your point, AJ, I mean, you got to remember, right? The government itself doesn't produce anything itself. Yeah, it's got a little bit of revenue from licenses, but it has to. The 4 points, I have it as 4.46, but whatever it is, the $4.5 trillion in revenue has to be sucked out of the private sector. And so as you suck more and more money out of the private sector, there's just the private sector shrinks, and it just can't grow. Like, you're trying to grow the economy, and if you believe that the growth comes from the private sector and businesses, whether they're small businesses, large businesses, whatever, when you're sucking resources from the private, you're just taking from the private sector, and they got to pay more and more in taxes, more and more in regulation. it just makes it very difficult for the economy to grow because you're really putting the private businesses, you're giving them, crutches. It's like it's really hard for them to get going.
Well, first thing we got to do is stop the bleeding, right? Like the problem is that something always comes up. Something always comes up that we got to spend money on, a war, whatever. And it always comes up. So what, in my opinion, the only thing that's going to stop is if we need a constitutional amendment bill, not one of these like ordinary bills, the money bills, these things these acts that they pass, and then just the next person goes and changes it because a new crisis comes along. We need a congressional hearing, and we need to put it in the Constitution that we cannot raise the debt any more than the same rate as the GDP or something like that. Whatever the rate the GDP rises, that's how much we can raise the debt. But that's it. You can't do any more than that. And dude
has been an American citizen for 6 months now, and he's already proposing constitutional amendments.
That is the most American thing ever.
Let's do a little civics lesson for the Canadian. Here in the United States, and I'm not even born here, but here in the United States, in order to get a constitutional amendment through the door, you can't just get the Congress to do it, right? You've got to not only get the Congress, not only the president, but then you got to get a majority or a supermajority of all the states. All the governors need to amend, right? So good luck getting that passed.
Oh, he took the test. He knows.
Oh, he took the test? Did you pass?
I got it was only 12 questions. I got the first 12 right, and they said you're good.
C's make degrees.
They must have not gotten to the how do you get a constitutional amendment through the door?
No, I realize how hard it is to get, but that's the point. Is that it's that hard to get because it's that hard to unwind, and that's what you need. You can't have this one of these ordinary bills that all of a sudden someone says, "Oh, this is an emergency. We need to give $800 million to Ukraine, or we need to whatever the current thing
it's
of
like
the time is."
We have no money yet. We're giving all this money to Ukraine. Another stat, just to kind of close the loop here, is this is, by the way, again, the Congressional Budget Office, which is probably the most gets everything wrong all the time and kind of understates things. But they were projecting Zero Hedge and these guys, Bloomberg, were projecting 1.6 trillion potentially by the end of this year. The Congressional Budget Office was projecting 1.6 trillion in 2034, which is 10 years from now. But even at that number, that means over the next 10 years, we'll be paying $12.5 trillion in interest payments over the next 10 years. That's a lot of freaking money to be paying on interest, which again is money that's taken away to go wherever you think money should be going. Homeless, Medicare, Social Security, tax refunds, wherever you think money should be going, it's going to be going to pay interest on the credit cards that we have. And I think at some point, people are going to realize, like, wait a minute, holy crap. I actually, even though they tell me that, I don't really believe it, but my tax dollars are going to pay this debt. And I just think at some point it's going to be a major issue.
So one of the things that I think Americans, we don't quite understand is obviously the debt, but where our money is being spent. And it's actually kind of shocking at the amount that we spend on certain items. Like if America, we complain about our healthcare system, everything else, but technically speaking, we do have universal healthcare. So I don't know if you knew that, but technically speaking, we are universal healthcare. Why? Because the majority of the citizens are on government paid programs. 60% of all Americans are healthcare is paid by the government. So we are technically a centralized plan because the majority of citizens are getting healthcare through the government. That's wildly different than it was 25 years ago, right? But between health, Social Security, that makes up like 50%. And Social Security is getting not only bigger, but we have the largest liability that is ever coming down the pipe of the United States. And that's the baby boomers. The baby boomers are going to be, sorry, Mauricio. We know you're 65 from the last episode. So that's, if everybody refer back to the last episode to see his age.
Like we've been discussing, he doesn't look a day over 60. So you're doing great.
That's right.
I must have Alzheimer's. I don't remember the last episode talking about that.
It happens when you get close to 70 plus. Don't worry. It's okay. I got some vitamins for you.
Got it. Just a quick little break here. So I poured the other pisco, the Peruvian stuff. I was not impressed. So I want to give a chance to all my Peruvian friends. If you guys have a really good Peruvian pisco, drop a comment and give me a recommendation. Or maybe I'll try it on one of the future episodes because this is a really cool bottle, but I don't know. Not really that impressed with the quality. So give Give me a good Peruvian pisco and I'll try it.
You'll get a book out of it probably too. They were just giving away books this episode.
I'm giving away books, man. You do a drop a comment, I'll send you a book.
All right. Well, look, I think the biggest issue here is what is going to be that situation where we see a crisis, because as I pointed out before, like there's no magic bullet number where it's like all of a sudden we hit this amount of debt or our debt becomes this percentage of GDP, or like they're just going to keep doing it until they stop getting away with it. And when are they going to stop getting away with it? Anyway, I guess this just leads to like people that get worried about the dollar, right? Like the dollar dominance, like we're okay right now because the dollar dominance, and I brought up about the treasuries and that, are you guys, I guess, worried about this is going to lead to a devaluing of our currency?
It's another step. I mean, these things don't happen overnight. It's not, I'm not saying this is going to be the end of the world tomorrow or next week or next month or next year. But we're getting there.
I agree with Mauricio. I think that the problem is it's not like when you should sound the alarms before it's there, right? Like that's the fundamental problem with it. And I think we are at a point where very smart people, right? A lot of people are starting to get concerned, and it's actually starting to get more mainstream where it's going, this is unsustainable. And at the rate we're borrowing with, it's staggering right now at $1 trillion every 100 days. So I think that once again, I agree with Mauricio. It's not like tomorrow the world's going to die, but we are getting to a point where our borrowing and our spending is ramping up at a velocity that we've never seen.
So instead of holding dollars, should we be holding gold?
Ooh, what a transition. What a masterful, Kyle may have been on a cruise ship with his blind wife, but he still got it. He still got it.
Well, this is how you pivot. Since the U.S. was taken off the gold standard and fiat currencies became the go-to, gold historically has been a hedge against volatility and potential stock market uncertainty. Well, with everything that was going on with COVID and surrounding like that, everyone, the wars that were going on, people thought that gold was just primed to take off. And then it kind of just didn't. It kind of just stayed where it was and bounced back and forth. Well, finally, gold got the memo, and it's been on a tear last month. So, Jay, my question to you is gold still considered a type of hedge or insurance against bad things happening, or should we be looking at it differently?
Okay, let me start with I don't have anything against gold, but I'm not one of these people I'm not a gold bug. I don't think gold is the end all be all. And yeah, gold, as Kyle, you said, got the message recently, and we just hit all time highs on gold. Almost got to $2,300 an ounce today. But the reality is, every asset class is at an all-time high. So the stock market's at an all-time high, and single-family real estate's at an all-time high. Bitcoin just hit an all-time high.
But is gold an asset class?
Gold is an asset class. It certainly is. It's an investment asset class. And just like everything else is going up in value, gold is going up in value because there's a ton of money out there that's kind of pouring into everything. And I'm not saying there's not other reasons, and we can discuss those, why gold is doing well right now. I mean, bond yields are starting to drop. It's likely that we're going to see interest rates go down. The dollar is weakening. So there's other reasons why gold is doing well right now. But the reality is that everything is doing well right now, and I don't think it's indicative of the fact that gold is a good hedge. In fact, the fact that we talk about gold as a hedge, you would think gold shouldn't be doing great right now, because what are we hedging against? The economy in nominal terms is doing better than it's done in a long time, and so what are people hedging against with gold? So I would argue that right now, the reason gold is doing well is just because there's so much money out there, and there's money pouring into pretty much every asset class. Now, let's talk about like the good and bad of gold in general, because a lot of people are thinking, do I want to add gold? And again, I don't have a ton of it. Well, literally, I don't have a ton, and figuratively, I don't have a ton. But the reality is, I think most investors have more than 0%. And a whole lot less than 100%. And so where's that sweet spot? And I think you have to look at the pros and cons. The reality is that there are some good reasons to own gold. One, it's inversely correlated to the US dollar. So if you think the dollar is weakening, gold is a great way to hedge. It's a great diversification. There's negative correlations between gold and other asset classes, or not even negative correlations, but lack of correlation to most other traditional asset classes. And it's a great store of value. So in reality, gold is, I don't want to say it's a hedge against inflation, but it's a hedge against lots of things. And we can talk about, because a lot of people think gold is a good hedge against inflation. But I would argue if you actually look at the data, and I can bring up a graph to show this, it's actually not that good of a hedge against inflation. It's just a good long-term store of value. On the negative side, there are definitely some negatives about gold. One, it doesn't cash flow. And so you're holding it, hoping that it goes up in value. You can't live off of it. You can't eat it. You can't drink it. I mean, if you need it, you need to sell it because it's not going to generate cash flow for you. Unlike real estate, unlike like dividend paying stocks. And it doesn't have intrinsic value. And I know we can argue over the definition of intrinsic value, but in my mind, gold is no longer a currency. It's no longer backed by a government. And so, or maybe it's the other way around. The government's not backed by the gold. And so it doesn't have much intrinsic value. Yeah, you can use it in some electronics applications. You can use it in jewelry. It's pretty, and people pay to eat it apparently in some countries. But the reality is it doesn't have much intrinsic value. So I look at gold as basically you add it to your portfolio because over the last however many thousands of years, it's tended to hold its store of value pretty well. It will likely continue to hold its store of value, but it's not going to, I think, outperform most other asset classes as an investment. So there's kind of my thesis. And I think gold is likely to do well over the next couple months or even years, just as we see interest rates go down and bond yields go down, as the dollar is likely to weaken just because the dollar has been so strong the last couple of years. I think gold's probably going to hang in there or maybe even do well. But I don't, for me, it's not a long-term investment asset class for any significant part of my portfolio.
I want to hear from AJ because I know he's got to run, and I got a lot of thoughts on this, but I want to defer to AJ first. AJ, bust out that graph. You had a money graph, and I think you should share it. You should show it. You should describe it to the podcast audience that refuses to watch this on YouTube.
Well, while he looks this up, I just want to make one point that like all of these hedges that Jay mentions and the inverse relations and versus inflation and stuff, that actually a lot of those things held up pretty well until pretty recently, in the 2000s. And it's almost, and I have a theory that, some of it had to do with crypto because gold used to be something of a hedge against, a US currency or the government or, something bad happening to, your local currency. And now there's other options, right? There's, if you're worried about the government coming and, seizing your bank account, it used to be your only option was to have a bunch of gold to prepare for that. Well, now you can have a crypto account that the government can't take, and other options. If all of a sudden the US dollar goes to shit, like crypto takes care of that, right? That you could transfer crypto into any other currency. So I would argue that a lot of these reasons that people holding gold before, now that responsibility is split between gold and crypto, and that might be changing historically how some of these things react.
So gold has a direct correlation with debt. So my whole thesis on gold is if you are a gold investor, it is predicated on debt, the US debt load. And so if you look at gold, let me share this real quick. The correlation from 1970 to today is almost directly correlated with debt. Over the long term, it is directly correlated with debt. So for everybody listening to the podcast, from 1970 to 1923, gold, its gold price and the total public debt track very much in line. And outside a few years, which we've seen, gold and debt, they rise together. Now, this is largely driven because of what gold is. gold is a hedge, right, against a fiat currency. And the correlation of debt and the fiat currency is obviously direct. What are the odds that this currency may not hold up and that we would have to leave it and go back to a gold standard, or that gold would be an alternative option? And that plays well, right? So that plays really well if the United States is having problems, if you're worried about whether or not the United States will be able to pay its debts, or, as this chart shows, how much debt the United States is taking on and how much debt it'll continue to take on. If the United States debt starts to lower, which it's happened twice, gold immediately reacts and goes down with it. The longer the debt accumulates, the higher gold prices rise. So the price corresponds directly with that debt load. Now, when you think about gold, there's a few ways that people use it as an investment. My underlying assumption, though, is a lot of people are like, oh, well, the dollar is going to go away. And then they're buying like gold ETFs. That makes no sense to me whatsoever. That is actually quite weird, because I don't know why a gold ETF, you don't own any gold at all, and you are basically directly correlated with the stock market. So if you own a gold ETF and we go off the dollar, your gold ETF is not going to go up in value. You don't own anything. You don't own it. And so I think some of these products people use some of the derivatives people use are actually counterintuitive than what they think. There's a lot of people that I know, well, at least I own gold. How do I own it? Through an ETF. No, you don't own it, right? So if you're a prepper, owning gold to use in trade is obviously different than if you own a ETF or a stock that is a gold producer. So if I own a stock on a gold producer, I'm saying we need to the gold is going to rise in value. So the production of gold that they have, right, they'll be able to sell at a higher value. So the business is going to go up because the product will be worth more, right? So that is a investment in a company that produces the commodity, right? Then you have other plays, which is you're just buying trackers that track gold price because you believe that the price of gold will change. All of these ways, though, to use gold in general are hedges, right? So they are plays and hedges on currencies and things going on in the market, which has always played out, right? If you follow it as far as debt goes. I'm actually in the boat with Jay. So I do not believe gold has fundamental value. Only value comes from an extrinsic value, and that is the value that a marketplace of buyers and sellers put on it. That's it. So because of that, I can't measure its value, so I don't like it. Meaning that I'm betting, and that's what you were doing with gold. In all instances, you are betting that market participants will value that higher than they did previously due to outside circumstances, but you don't know if they will or not. So there's no way that we can assess, underwrite, or value gold without taking into assumptions that the future demand because of market participants will go up.
But that's just like any fiat currency or crypto or anything like that. There's basically no.
Yeah, that's why I don't invest in crypto. There is no underpinning value.
Well, so but you and Jay keep using the word invest and asset class, and a lot of people, including myself, I don't consider gold an investment or an asset class. I consider gold basically more like an insurance policy.
Thank you, Kyle. Kyle still got it. He still got it. He's been gone for a week, but he still got it.
But you may consider that, but markets don't. So just because you consider that, which I agree with you, Kyle, I don't consider it an asset or an investment. But that doesn't matter. That's not how anybody classifies it. Gold is an actual underlying asset, and that is how people view it. So if you have gold, you put it on a balance sheet as an asset, right? If you own gold stocks, it's an asset.
Name another asset, if you guys want to call it an asset or investment, name another asset or investment that the central banks basically keep as reserves. Like other than US dollars or other denominations of countries, like gold is the only other one. So if you want to talk about make the argument about
they have silver holdings, they have a few other commodities that they hold in reserves. They oil They hold oil in reserves, and that's classified as an asset too. It goes on the balance sheet as an asset. Commodities are assets.
Okay, fair enough, but you get my point though. It's not like it's not like crypto. Like crypto is a lot riskier because that's basically just the consensus between, the populace that has value to this. This is something.
Oh, crypto's way riskier. I agree with you on that. Chris, it has no underlying value.
This is something that the world powers that be, the world banks have decided as a reserve value, store of value. So, I'm going to consider it the same. I'm going to say that.
Well, and there's utilization. We can actually use gold. We can actually use oil. People buy it. It's used in building materials. There is utilization of a commodity, and that's why it's an asset. Whereas crypto is not a commodity. It does not have utilization outside means of exchange or derives value from something else. So I completely agree with you.
But crypto is an asset. I mean, crypto, if you put crypto on your balance sheet, it's an asset, right? I mean, just like everything else.
It's an asset. It has no intrinsic value, though.
That's fine, but it's an asset. I mean, look, I think you guys are kind of dancing around a little bit, but I mean, first of all, Kyle, just to your last point, I mean, I don't think it's central banks that are saying it's valuable. I mean, I think ultimately gold has been used it's really the free markets. I mean, free markets have determined that they've been trying for 6,000 years, right? They've been trying to figure out what's the best store value, what's real money, and gold over whether they're right or wrong, the market over the last 6,000 years has determined that gold is the best form of a sort of a money because, they've used cows before, they've used, tulips, they've used all kinds of stuff. But over 6,000 years, the free market has determined that gold, because of all its characteristics, its store value, Jay, you mentioned it, it's divisible. It really has all the characteristics of money. So my point in all this is that gold is, everybody's been dancing around it, but there's really, it depends on how you look at gold. There's really three ways people generally look at gold. And I'm hearing all three of them kind of when I'm hearing you guys. But when you talk to gold people, they fall in one of three categories. Number one, they consider it an investment. Just like we've been talking about now. It's an investment, it's an asset, it's going to go up. What's my return? How do I value it? It's an investment just like oil, just like crypto, like whatever, stock market, real estate. It's an asset. Is it going to go up? Gold's up 10% this year, down 10%, whatever. That's one. Number two, Kyle, you alluded to it. Also, people think of it as an insurance policy. Hey, I'm going to hold gold. It's an insurance policy. If the whole economy goes to crap, then this is going to hold its value and it's my insurance policy. That's how a lot of people view it. And I do agree that on the insurance part, crypto has definitely played a role in that because let's just think about this. I strongly believe, hopefully AJ didn't leave too early. I strongly believe that if it wasn't for crypto, like if you told me tomorrow crypto goes down to zero because it suddenly just blows up and literally it's worthless, nobody cares about it, all the money moves away from crypto, you'd probably be seeing gold at like $2,700, $3,000. I mean, it definitely has stolen some of the capital that would have ordinarily flowed into gold, has now flowed into crypto. And so that's definitely taken some of the luster around. And I've talked to a lot of experts. I mean, I'm no expert in gold, but the good thing about my position is I know a lot of gold experts, and that they definitely feel that crypto is definitely, for now anyway, diverted some of the capital that would have gone into gold for store value, for insurance, for whatever, the dollar collapsing, whatever all those arguments are. Now there's a competitor. It's crypto. And so some of the money's flowing into crypto. Some of the money's flowing into gold. That's definitely a second thing. And the third thing, which is really, I think, where really the gold purists come out of, is that gold is just, it's money. We have this paper fiat currencies. We have dollars, we have yens, we have yuans, but they literally have no value whatsoever. They're literally pieces of paper that you can use as toilet paper. But the only reason they're valuable is because the government says they're valuable. But if you look at the free market, quote unquote, money, the real money, and to your point, I know you're from Canada, Kyle, but this Constitution even mentions gold as being money, like money is gold and silver, that the purists will argue that money, because of all of its attributes, because it's got the store value, because it's divisible, because you can do all these things, that gold is money. So it's really more comparable to the dollar or the yen or the yuan. It's the dollar. It's the currency, but also it's the money, because what else is going to be money if you don't just have the government bill? So I think you got to fit in where you think this is. Is it investment? Is it insurance? Is it real money? And to your point, Kyle, central banks think of it as really money. because they do use it as reserves. That's one of the reasons gold is going through the roof right now, is because central banks are in a buying mode. They're buying. If you look back, 10 years ago when gold was, gold went down like basically half the price it was today. Central banks are net sellers. Central banks were just selling for whatever reason, because they needed cash, they needed dollars, whatever the reason was. They were selling gold. Now, between China and Russia and the U, all the central banks, which are the biggest players, are buying gold for whatever reason. You can argue why they're buying it, but they're net buyers of gold.
Well, that was good. I'm glad you went there, because that was going to be my next question is, okay, why did this go up the last month? Because you're right. It has been central banks have been buying the crap out of this. And actually, if you just look at like retail buyers like you and I, like they've been net sellers. It's just the banks are buying so much.
But think about it, Kyle. If you're Russia, right, why in the world would you hold dollars in some bank account that's going to get frozen and taken away from you from counterparty? One of the beautiful things about gold, this is one of the big arguments in favor of gold, it's the only asset class, Jay, you can correct me if you've got another asset class, it's the only asset class that has zero counterparty risk. If I have an ounce of gold in my pocket, there's no counterparty risk. An ounce of gold is worth an ounce of gold.
Tell that to the people in the 70s where gold was illegal to hold. But
yeah, but like there's no counterparty risk. And so if you're Russia, again, if you hold dollars in a foreign bank account, trust me, they have now realized, and the whole world has realized, that there's counterparty risk, that the US can use its power, it can freeze your bank accounts, it can control, Russia, I don't know what the number is, but it's got billions of dollars that it hasn't counted, it cannot access. The US is frozen, and other countries are concerned, like, hey, if I get on the bad side of the US, are they going to freeze my accounts? Am I not going to have access to my money? So
Russia's been very secretive, but according to their what they will release, it's 155 million. Sorry, 155 billion. You're right.
And China's another great example. I mean, China has whatever their official gold count, which I think it's in the 3,000 tons or whatever the number is that they have. But they're also, I don't want to say they're smuggling gold in, but they're definitely underreporting. And every so often, China, once a decade or whatever, they kind of update their numbers. So nobody really believes whatever China owns. I think they own much, much, much more. Some people think China is the largest owner of gold, even though technically the US, I think under the official numbers, is the largest gold holder. But then there's also, obviously, don't forget all the conspiracy theorists that says that the U.S. really doesn't have any of its gold. It's already leased it all out, and there's nothing down there. But anyway, my bottom line is, look, when you're thinking of gold, I think you've got to figure out which camp are you in. Do you think gold is an asset, and you're just going to buy ETFs, and you just hope you're looking for a return on investment? Hey, I buy gold today, and it's going to go up 10%, down 10%, whatever. Do you look at it as insurance? So yes, there's a cost of holding gold, but that's just the cost of doing business. It's an insurance policy. And so if what hits the fan, I got some insurance and my gold is going to go up even though everything else goes down. Or is it just money? Is it just reserves that I have? Hey, I have a bunch of money. Instead of holding, $100,000 in the bank that's going to lose purchasing power every year, let me just hold it in gold. And that's going to at least maintain. Gold doesn't really go up versus the dollar. Because remember, you've got to think about, when the dollar goes up, gold goes down, and conversely, when the gold goes up, it's really just the dollar going down. So if you believe the dollar is going to lose a bunch of value, then you might as well buy gold. But it's not that gold's going up; it's just it's going up in relation to a falling dollar. But if you think of it as real money and you want to keep it as reserves in your savings account instead of holding dollars in Bank of America, you can hold gold because that's going to preserve its purchasing power over the long run, right? And again, in any particular year, it can go up and down.
Well, this will probably be a controversial statement, but yes, gold is a store of value. If you look historically, it's about as good a store of value as real estate. And we can argue that real estate has other value, especially investment real estate. But if you're buying real estate simply to live in it and keep it, just like with gold, it is likely to go up at about the rate of inflation over time. And we have seen that gold has done pretty much the same. Certainly, there are much more variable periods. Some periods where it does big leaps, and some periods where it stays flat for a decade. So it's definitely more volatile than real estate has been. But it's very similar in the sense that it is a store of value. It's a way to protect your money against deflationary pressures, and an increase in the money supply and a weakening dollar.
Yeah, what's the old adage? The old adage where, like, at any time in history, one gold coin bought a custom men's suit. Like if you go back to the 30s, it bought, one gold coin bought a custom men's suit. If you look at right now, $2,000 for a custom men's suit, that's about in line. So
And same with real estate. You look at what did real estate cost back in the 1950s, and you just do the translation and how many ounces of gold did the average real estate home look, and now look at it today. But what I love about this is a kind of I think this is a very interesting thought experiment. I want to throw it out there, and I know at one point, Jay, we're going to do a whole episode on crypto and tokenization stuff. But to your point, though, what you said is exactly, in my opinion, is exactly right. Like real estate is just as good as gold in terms of a hedge against inflation. Literally, real estate, generally speaking, on average, doesn't really go up. It just inflates. It just keeps up with the rate of inflation. So very similar to gold. The problem is gold. I can buy an ounce of gold. Well, now it's a couple grand, but I can buy gold for $2,000. I can't buy a piece of property. Like not everybody's gangster rich like you guys and go buy tens of millions of dollars of property, right? So that's a barrier.
And you can't really get debt on gold, which debt is the best inflation.
That's another point too. That's a good point too. But ultimately, what I'm super fascinated, and I just scratched the surface of this. So this is just a kind of a thought experiment, but it's not my original thought for sure. But there's this growing movement that we are moving into a place where real estate can be tokenized with crypto and blockchain. So now you have let's just call it just for math purposes, you have $1 million property, right? I can't afford $1 million property, but if you subdivide that into 1 million tokens of a cryptocurrency that's on blockchain, well, now that one millionth of a share of the real estate I can afford, and that's only going to cost me $500 or $1,000 or $2,000. Now all of a sudden I do have access to real estate where previously I can't. And more interesting to me is you can trade that. Like when I come by, Jay, when you want to sell me your bottle of wine, instead of giving you $100, I can give you 1/1 millionth of my real estate portfolio because it's all tokenized. That to me is a very fascinating world where I do see a scenario where 50 years from now, everybody's trading, not in crypto, not in Bitcoin, not in that, but literally, hey, I have my portfolio, whatever assets I own, I can create my own currency by tokenizing that. And I think that's the point with yours. There's a lot of other assets that until recently were not divisible, because that's one of the key things of money. The reason gold is so appealing is that you can divide that into whatever.
Do you think that the onset of that happening is going to diminish the value of gold?
Potentially, because if suddenly real estate becomes more of the, hey, anybody can buy a piece of real estate for $500. And so now again, it's another piece of the menu. I can either go buy Bitcoin and whatever other cryptocurrency I want, or I can go buy gold, or now I can go buy real estate. Because I can just get, you guys own a property that's worth $1 million. I can buy one millionth or 1 bazillion. I mean, literally it's infinity. I can divide that thing into a bazillion shares, and I can buy $10 worth of your property. And then I can trade that. I can buy your guitar for one bazillionth of my real estate. It's just an interesting thought experiment.
I was so certain that we had talked about tokenization on this show at some point, but I just went back and I looked through all the episodes, and we have not talked about tokenization. So
you know why, Jay? We did talk about it on our previous podcast. That's the one that started Drunk Real Estate with Mauricio. And so we brought up tokenization on that. So that was like a pre-episode. That was our feeler to decide.
The prequel.
Okay, maybe we'll talk about that next week.
But let's wrap this up. And I was hoping to hit AJ with this question too, because I'm not actually sure. So Jay, we know you have some gold. Mauricio, do you have gold?
I can neither confirm nor deny any ownership in gold at this point in time of my life.
So Mauricio has gold. He just doesn't want anyone to rob him. Jay, why do you? So you've been like through this segment, you seem like you've been a little bit anti-gold, yet you hold some. So why do you hold it if you don't believe in a lot of the reasons that people should hold gold?
So one, I think physical gold is kind of cool to own. And so I'm not going to lie and say that all my investments are strictly because I think they're good financial investments. I think it's cool to own some gold.
Hey, if everyone spent their stimmy checks on gold instead of what the Amazon, then they would be a lot better off right now.
Yep. Two, I don't believe that the zombie apocalypse is coming and the breakdown of society is coming anytime soon for any reason, but it's going to happen eventually. And maybe it's 100 years off or 200 years off, or who knows, maybe the next the next COVID type event happens and we do have some type of breakdown in society. And gold and silver are two very, very popular trading items.
Yeah. If I were to hold gold, I would hold it as a reserve asset and insurance policy. That's the main. I wouldn't think of it as an investment. I wouldn't buy gold.
Insurance against what?
If the dollar collapses, gold will go up because it's in relation to the dollar. So if the dollar collapses, if there's a war with China, if whatever happens,
Zombie apocalypse.
It doesn't need to be zombie apocalypse. We could default on our debt.
When COVID happened, usually what happens, here's what happens. I'll give you a little hint. Usually, like COVID's a great example. It happened again. It's happened in 08, in 2000, and then in 2020. And if you go back, it always happens. When a crisis happens, this is a great thing. If you're looking for an investment play, you got to send me a commission later when you make money on this play. But whenever something terrible happens, like let's say a COVID kind of thing, remember the COVID March 2020. If you look at the gold price of March 2020, you usually see a drop in the gold price because liquidity is a problem and everybody needs to just sell and get liquidity. And what they have is gold. And so that's an easy liquidity. And so they tend to sell gold so they can make their interest payments, so they can pay whatever mortgage they have, whatever payments they need to make, they don't have the dollars for, they get gold. So gold typically goes down slightly in a crisis and then it just takes off because it doesn't have to be an apocalypse thing. It could just be your usual garden variety. These days, the garden variety recession and disaster. So look at 08, look at 2020, and you'll see gold after that initial dip when people are liquidating to just get cash. It just takes off. So I look at it as an insurance policy. If when COVID 2.0 happens or when the great financial crisis 2.0 happens, gold will, when the stock market is collapsing, gold will hold up. And you don't need 100%, 50%. Most experts recommend 10% of your holdings being gold because that 10% will counteract whatever crash in the stock market or real estate market or whatever else is collapsing. Gold will be your insurance policy and will not only hold its value, but it'll actually, in relation to those other assets, will go up to kind of counterbalance the loss of the rest of your portfolio. Just 10%.
Yeah, I will 10%. So like I've kind of looked at, I'll give you an example of a reason I buy gold. I went and bought a bunch more gold. I already had gold. I bought some when news of the Ukraine war happened, right? And all of a sudden the chances of us getting nuked goes up significantly. And so then it's
zombie apocalypse.
Well, I don't know if getting nuked will create zombies, but it could create a situation where, traditional economies with, using credit cards to buy things might not be around, or, there's numerous reasons why, or just, as I said before, what if we default on the debt? Like we might get to a situation where we default on the debt and all of a sudden the US currency drops 50x in value. Well, if I hold 1% of my net worth in gold, then all of a sudden the US dollar collapses by 50x. Well, my gold just went up that much. And now it's protecting my net worth that way. So I think it's a great idea for someone. And I don't think that's much of, your portfolio, just 1% to, holding some gold and silver. I don't have any crypto at the moment. I did before. Because I feel like they serve kind of the same purpose, and there's a little bit less volatility in gold. But that's just me as far as how I treat it. As I said, I treat it like an insurance policy.
Good enough.
Agreed.
All right.
I think we all agree.
So let's wrap this up. I did, based off of this conversation, I did look up a quick top 10, even though I was a little bit late. I know, Mauricio, you're so upset.
Top 10 ways to hold gold? Is that what we're doing?
Well, no, I'm going to do the top 10 countries' gold reserves. So obviously the United States is the highest with 543 billion. Who do you think's number 2?
Germany,
number 2, 224. Then we go Italy, France, Russian Federation.
Really? I would not have picked Italy anytime in the top 10.
Italy. So I think this is 2023 numbers though. Q4 2023. So it's actually pretty recent.
How many thousand tons does Germany have on that list?
So Germany has 3,352 tons.
Got it. What is China officially on that list? How many thousand tons does China have?
So China's at 2,235, but in 2023, they were the largest gold buyer.
Yeah, and then if you listen to the whisper number, I mean, they think China is way over 3,000. So I mean, on the unofficial number would be number
There's
two,
a caveat on China and Russia that
right?
this is they're required to report, but Russia all of a sudden in one day will have 100 tons will be added in one day, and they obviously didn't buy 100 tons on that day. They kind of just mess with the numbers, and it's in their best interest, especially when they're invading countries, for us to not know how many tons.
Yeah, that list is similar to the wealthiest people in the world list, where you think that all these wealthy people on the Forbes list, but in reality, you know, there's other folks that make a lot more money.
Well, so Russia and China are back to back, number 5 and number 6, but general consensus is they're probably much higher on the list.
Is South Africa on that list anywhere?
No, they are not on the top 20.
So who rounds up the top 10?
So number 7, Switzerland. Number 8, Japan. Number 9, India. Number 9, India. I got to turn my hat on sideways. And number 10, the Netherlands.
The Netherlands.
So where was France on that list?
Yeah, France was number 4.
Okay. Fun fact. You know where France got most of their gold from? The U.S. So one of the big reasons we moved off of the gold standard, Nixon moved us off of the gold standard, was because with inflation, France was concerned that that dollars wouldn't actually be tradable for gold at that $35 set price that that Roosevelt defined back in the 30s, and they started cashing in their gold. And the U.S. saw this as a risk because France basically bought all of the gold in the U.S. We couldn't afford it because there was more money out there than we had gold, despite the fact that legally there shouldn't have been. So that's one of the big precipitating factors.
Yeah, in August of 1971, we temporarily closed the window of that trading gold for dollars, and it's been about 50 years since we temporarily closed that window.
Yep.
And then it was illegal to own gold for a little while there.
That was between 33 to 74, I think.
Yeah. So cool things happening with gold. All right. I don't have a game. You guys got a game to play? I didn't have time to come up with something.
I want to reiterate, if you guys missed it at the beginning, drop a comment, like, subscribe. If we don't get to 1,000 subscribers on this episode, I'm going to be really depressed. So yeah.
Yeah, Jay, I thought you were telling a joke every week. Wasn't that the new thing?
Oh, we're going to tell a joke?
Yeah, it wasn't. It didn't get that great of a reception last week. So
the analytics were not kind to Jay's joke, which I don't blame him, by the way. I don't blame him.
All right, Mauricio, you plugging your book?
I am not going to plug the Legal Strategies for Everyone book because I've plugged it already throughout the show. What I'm going to plug is, Jay, when are we doing our thing? Are you going to plug your thing and I'll plug my thing? You're going to be on the show. You're going to be on the show.
Oh, yes. So
Jay, so you plug yours, because then you plug yours first, and then I'll plug. I won't plug you, but I'll plug next.
Yeah. So I am going to be doing a webinar on April 24th, geared towards people that are interested in learning how to do multifamily underwriting, large multifamily underwriting, and we've already got like 500 or 600 people signed up for it. So I can't tell you where to go to sign up for it. Damn, I'll do that next week. I don't have a nice custom URL for that right now. But next week I'll have a good place to go. Or if you drop me a comment and you subscribe and you like this episode, I will post in the comments or in the description a link to sign up for that webinar.
So if you can't wait for that, Jay is going to be a first time. Are you like the 5th time guest on Real Estate Syndicator Live? So you're going to come on the 22nd of April to do a kind of a preview on I've been wanting to do an underwriting show for many, not years, but for a long time. And Jay's going to come on and do kind of it's only an hour. So we're going to do a high level, how to underwrite multifamily properties on April 22nd, realestatesyndicatorlive.com. And that'll give you kind of a taste of what he's going to talk about on the 24th, where we'll do a deep dive.
And the ironic thing is, everything I learned about multifamily underwriting, I learned from Kyle Wilson, who is apparently just too shy to be on your show.
That's the problem with Kyle. I've been trying to get Kyle on the show for like 2 years, and Kyle's like, oh, I don't want to do it. I'm like, I don't know. So that's why Kyle's not been on the show. AJ's been on the show. Jay's been on the show 4 or 5 times. I can't get Kyle on the show because he's too shy.
I only do shows if I can drink. That's why I needed to create Drunk Real Estate.
Alrighty.
All right. Well, I got to actually, you know what? I am going to plug 2 Ashleys tonight. I feel like I have to plug both Ashleys because I had such a good time on my trip. So I always plug my wife, Ashley Wilson, Badass Investor. I'm also going to plug Ashley Care, Wealth from Rentals. She's also has her Bigger Pockets rookie podcast. Go check her out there. And yeah, so I got to plug 2 Ashleys tonight.
Dude, I want to go on this cruise next year. We're plugging a couple Ashleys over here. I'm gonna join the cruise next year.
We'll bring your wife. I don't want to bring the ratio down.
You're still bringing the ratio down. I'm not gonna explain the math to you.
I know. After I said that, I was like, geez, it is that it actually does bring the ratio down. But you'll bring 2 girls, then that will be good. All right. I don't know about you guys, but my Bud Light was gone half hour ago. So I'm gonna go hit the head, and I will see you next Tuesday.
See you guys.
Peace.